just after the market rout that we've seen, perhaps these sorts of steps, even if piecemeal, are still needed.
Yes, I mean, there's a lot of factors at play, but the two main things that I'm looking at is obviously the national team, if you want to call it that, is probably coming in to help support. You've seen that with some of the northbound data flows, some offshore funds coming in through Hong Kong northbound, boosting the CSI 300 by the close. So we've seen that, and that's essentially what the data is showing. China equity benchmarks rebounding started coinciding more often with buying by offshore participants through the trading links with Hong Kong. 8 out of the last 10 sessions have seen inflows into the mainland shares from the northbound program. One of those days, the CSI 300 index saw intraday rebounds just as northbound flows started turning around. So that's not just anecdotal evidence. That is pure data-driven evidence right there, that there is some sort of national team trying to prop up the A share market in Shanghai and Shenzhen. But the other side of the story is much to the neglect, if you will, of the small caps. So the CSI 1000, a different story than the CSI 300. Bring up the chart year to date. It's down about 27% for the small cap index right there. And that's also leading to a lot of the angst among retail, younger, if you will, investors in Shanghai and Shenzhen who feel they've just been absolutely obliterated on the markets, that it's a casino as we head into the national, the Lunar New Year holiday. People's paper wealth has been deteriorated. So that is something obviously the government is worried about. Let me talk about those piecemeal new efforts that we're hearing from sources are saying that the Chinese government and regulators are trying to take or are taking to essentially boost sentiment, put a floor on this fall in the market, and perhaps lead to what a lot of people have been saying eventually is going to likely happen, is going to be sort of a stock stabilization fund. We just don't know how much that's going to be. One academic at the Chinese Academy of Social Sciences yesterday essentially said it needs to be upwards of 1.4 trillion US dollars.
10 billion.
10 trillion. 10 trillion yuan. All right. I keep on deflecting away from these measures. Basically, sources are saying authorities will impose caps on some brokerages, cross-border total return swaps by clients, essentially, Annabelle, limiting a way for China-based investors to short Hong Kong stocks. So that's going that direction. Hong Kong shares down 9% so far this year, the Hang Seng Index. At the same time, some Chinese brokerages that use the channel to buy mainland shares for their offshore units have been told not to reduce their positions. Okay, so that's going this way. So again, that's trying to support the A-share market. Now, also, some quant hedge funds, meanwhile, have been banned from placing sell orders completely as of yesterday, Monday, while others were barred from cutting stock positions in their leveraged market neutral funds. This is what's called a direct market access strategy. It's believed to have essentially amplified what I talked about earlier, and that's the selling off of these small cap stocks.